This morning on the Ag Issues program, a pleasure as always to bring back to the program Roger McEowen, professor of agricultural law and taxation at the Washburn University School of Law, as he joins us on the program this morning. Roger, good morning. How are you?
Good morning, Greg. Just fine. Good to be with you.
Good to be with you as well. Did you get much rain up on the farm yesterday?
Yeah, it's hard to tell. It was raining pretty hard yesterday afternoon, and I'm not sure how much in the evening, but I did notice last evening, right about dusk, it was starting to change over to ice, and it was getting on the trees and the limbs and on the lane and so forth. So, since I didn't come into the studio this morning, I'm not sure what the roads are like this morning.
Indeed, indeed. All right, let's get to it. Typical this time of year, and we've seen this in Kansas many times before, having to deal with prairie fires, wildfires across Oklahoma and Kansas almost 2 weeks ago now, but definitely leaving the cattle ranchers facing a complex landscape of legal and tax hurdles. This is just beyond and if you were unfortunate that you were had damage to the fire or devastation from the fire as well, of forage and livestock as well. But there are many things that we have seen associated with prairie fires that the ranchers have to go through.
Oh, yeah. And you think of some of those people out in the Ashland area that got hit, what was it, 7 or 8 years ago? And I went out and did a seminar for them shortly after that event, after it was safe to go out there, and went through a lot of these issues with them. And now here they're faced with it again. But when there is a prairie fire, there are tax provisions that can help with dealing with the loss. And it's important not only to keep good records in this situation, but be aware of what these provisions are that can help mitigate the loss. And so that's what I was writing about in the recent article.
And as far as some of the issues are concerned, and there are many, but let's talk our focus on a couple of them as well. First off, let's talk about forced sale rules.
Yeah, if you're forced to sell cattle early because you don't have any place to graze them, then there are two primary code provisions that come into play. One, we call this the 451G provision. This is a one-year deferral provision. So if you're on the cash method of accounting, which most ranchers are going to be, you can make an election on your return to defer the income from the livestock that you had to sell that were in excess of your normal business practice. You can defer the gain attributable to those excess for 1 year. Now, the area has to be designated for federal assistance, presidential or secretarial, due to the fire, and it will be. And then the deferral applies to the income from the number of heads sold above your 3-year average. And this is an election that is made on the tax return for the year of sale. And that's one of the provisions. That's a 1-year deferral. The other one is 1033E, and this one applies for draft breeding or dairy animals, not feeder calves. And so there's a nuance here between the provisions. So you can defer the gain entirely if you replace those animals within basically 4 years. Now, you can replace them with non-like-kind livestock, but you only have 2 years to do that. So you can replace it with farm machinery, other types of farm equipment, those types of things, but you've only got 2 years to do that. But if you're replacing with like-kind livestock, and it has to be like-kind livestock, then you have 4 years to do that. Now, if the area gets a continual drought designation or weather-related designation, the IRS can extend that on an annual basis. So it could become 5 years and then 6 years, but that's 1 year at a time. So your basis in the cattle that you involuntarily sold, you're using this provision, that's going to carry over into the replacement animals, and then the gain is deferred until those replacement animals are sold. So the point of these two provisions is that if you've got to dispose of excess livestock this year, you're not going to get hit with a big tax bill when it comes time to file your 2026 taxes. That's the whole point of those two provisions.
Roger, another part of this, obviously, with the multiple fires that we had, on the case of like Ashland, that was 9 years ago, as I have been told many times here in the past couple of weeks.
Wow.
And that has to do with the tax issues to be dealt with, and thousands of miles, literally, of damaged or destroyed fences that we have seen as well.
Yeah, and you think of the cost of rebuilding fences. It's not cheap, and we could see ranchers that are up in the hundreds of thousands of dollars in the terms of the cost of rebuilding fences. Now, after the Ashland fire, and it's, 9 years. Time goes fast. I was thinking of 7 or 8, but yeah, 9 years. But in that instance, there were some ranchers. I remember talking to some that had $250,000, $300,000 worth of estimated repair cost and replacement costs with respect to fences. So it's a big deal. But the problem you're going to run into here is that many of those fences are going to will have been depreciated out, which means you have no tax basis in those, which also means then there's no deductible loss associated with those fences. So if a fire is going to destroy the fence that has no tax basis, your deductible loss is zero, and the expenses that you pay to replace the damaged fence cannot be deducted as a current loss. So the only deduction that can be claimed is for what hasn't already been written off through depreciation. Now, fences, there's an argument they could be 15-year property under makers, but most likely many ranchers are going to treat that as 7-year property. And so if Ashland Fire was 9 years ago, that means it's fully depreciated. Or if you bonused it, or if you took Section 179 on it, you don't have an income tax basis in that. Now, it's not all bad, however. So there's a couple of other things to think about here. For fences that were entirely destroyed by fire, here's another catch we've got to think about. The IRS is going to generally view any reconstruction effort as a capital improvement rather than a deductible repair. So the cost of the rebuild would not be currently deductible, but you're going to add that cost to the fence's basis, and then you're going to depreciate it out over time. So if you have minor fixes, if I've got to replace a few burnt posts, for example, those would be deductible in the current year as an ordinary expense. But this rehabilitation doctrine that the IRS has, when you have a major fire like this and you got to basically start over, they're not going to allow that to be currently deducted. But however, to offset the immediate cost of a destroyed fence in its entirety, you do have, thanks to the One Big Beautiful Bill Act, you do have 100% bonus depreciation. You've got, in essence, a doubling, now more than doubling with the inflation adjustment of the 179 off the top depreciation allowance amount. Just think, Greg, what would be the situation that these ranchers would be in had the OBA not passed, and we'd be sitting at 20% bonus depreciation for this year. That 100% bonus depreciation can be a game changer in this situation. Then, if you get insurance on a destroyed or damaged fence that exceeds the fence's basis, that you got to report that as gain. But the gain might be avoided by treating the destruction as an involuntary conversion and then taking those insurance proceeds and reinvesting them into the new fence. So there's a whole lot of things to think about there. And this is, again, on these provisions, this is why it becomes very important to make sure you have good records, you've got cost records, you've got your basis information, your prior tax returns, and you're working very closely with your CPA or other tax preparer to help you through this.
Well, and then, let's take Ashland or portions of Ashland or south of Ashland, that is, that had the damage from the fire 9 years ago, had the damage from this fire, property value and related tax issues. Boy, oh boy, oh boy, that's you're living the same nightmare twice as far as where the property value will go in this.
Yeah, that's right. When you've got wildlife that scorches grazing land, the tax loss is not as straightforward as having a building that was destroyed. You can see that. You can it's tangible, but it's not quite as tangible when we're looking at scorched land. Now, that land still exists. So the IRS looks at the decline in the fair market value of what they call a single identifiable property, or a SIP. So for business property such as a ranch, the IRS is going to require those ranchers to calculate their loss for each unit. And what they mean by that is typically a specific tract of land that's affected. So when you've got a ranch, the land and the improvements, the fences, the corrals, they're often treated by IRS as separate SIPs. So you've got to compare the land's adjusted basis with the decline in the fair market value of the property, and then the tax deduction is the lesser of those two numbers. But how you put a number on all of this is you're going to have an appraisal. So that appraiser is going to come out, they're going to look at what a willing buyer would pay for scorched earth versus healthy pasture. And often the value drops because the buyer can't run cattle on it for one or two growing seasons. So sometimes the cost of repairs, and what I mean by that is reseeding and erosion control and debris removal, that can be used as a proxy for the decline in the fair market value. But the IRS will only allow that if the repairs are necessary to restore the land to its pre-casualty condition and the amount spent isn't excessive.
Roger McEowen, professor of agricultural law and taxation at the Washburn University School of Law, is joining us. And Roger, there are many things also to look at, specifically with wildfire damage, that many of those producers who went through the fires a couple of weeks ago. But let's look at property value and also related tax issues associated with situations like this.
Yeah, in Kansas, and of course, we probably have listeners in Oklahoma that were affected by this. But federal income tax is tied to income tax basis, but state property tax is often tied to productivity of that land, and indeed that's the case in Kansas. So Kansas values ag land based on productivity potential, not the market value. So if a fire destroys the landlord's share of net income, for example, because there's no grass to rent, then the county appraiser can be petitioned, and they need to do that by April 15, for a valuation adjustment. A little bit different in Oklahoma. Oklahoma has a constitutional cap on how much a property's assessed value can increase, and they limit that to 3 to 5% annually. So if the fire causes the market value to drop below the capped value, the property taxes should decrease proportionally. So don't forget about the property tax relief. That can be temporary relief, but that can give them relief in 2026. Plus, the other thing to think about, Greg, is there are USDA disaster assistance programs, and there are a lot of timing rules that have to be complied with respect to that, and legal compliance rules. You've got the livestock indemnity program that's going to get them payments for livestock deaths that are over the normal mortality rate that were caused by the fire. You got the ELAP program that's going to cover the cost of hauling water to feed to the livestock and the cost of transporting the livestock to new grazing land. Then you have the emergency conservation program, which could help fund repairs to fences and water facilities that were destroyed by the fire. But make sure you've got to have really good records of your livestock deaths. And, of course, the chaos of a fire can really hamper that. So watch the documentation rules that USDA has on these programs. Watch the timing of when things have to be submitted, and make sure you understand how FSA calculates your payments. And many times it's going to be based on losses that exceed normal mortality. And so you're going to have to prove how many head were owned the day before the fire loss occurred, and make sure you keep birth records, purchase receipts, loan documents, your tax records, vaccination, pregnancy check records. All of that becomes very, very important.
Well, and then there's the liability and property law issues as well, because if you lose a lot of your fencing out there, you may have cattle that have strayed out too.
Yeah, that's true. But there's for a rancher to worry about that type of situation, because in Kansas as well as Oklahoma, the injured party has to prove that the livestock owner was negligent. It's going to be pretty hard to prove that a livestock owner was negligent in the event of a prairie fire that destroyed fences and the livestock got out. So, there could be exceptions to that, but I think that's going to be a difficult case to prove for anybody that's injured hitting a cow out on a roadway because of a prairie fire.
Roger, I want to quickly move over to another topic of discussion. This is from a recent lawsuit filed in Kansas Federal District Court. It's representing a significant antitrust challenge in the agricultural transportation sector.
Yeah, this is a big deal, and this involves what we call the Elon Musk of agriculture. This is a fellow of Russian origin. He was born in the United States. He's a U.S. citizen. from New York, but he owns a lot of land in western Kansas. He owns the West Can elevator. He owns some rail lines. He owns land in Texas and in Colorado, as well as New York and elsewhere. But what we've got here, he and 13 farming and ranching operations in two corporate entities, his small railroad and his grain elevator, are claiming that the Union Pacific Railroad and the Kansas and Oklahoma Railroad have conspired to stifle competition from the newly rehabilitated Tower Line. That's a rail corridor that's owned by CXR, which is a former Missouri Pacific Railroad route in eastern Colorado. And that short line provides a direct westward route for grain. And the lawsuit is claiming that the Union Pacific Railroad and the K&O have conspired to stifle that competition by implementing what they call a paper barrier, which is a high interchange fee, about over $500 per car, by amending a 1997 lease agreement. And they claim what that is doing is making it economically impossible to use that rehabilitated Tower Line to ship grain west from western Kansas into Colorado. And instead, they're claiming Union Pacific Railroad and this other railroad are forcing farmers to ship grain 140 miles east before it could be routed back to the West Coast ports. And that has the effect, they claim, of artificially inflating costs and protecting the Union Pacific's monopoly on westward shipments. This is a really interesting case, Greg, to watch because that has basis implications, and that's going to affect the pocketbook of farmers and ranchers that are trying to ship grain in western Kansas. So it's an antitrust case based on the Sherman Act, and there was a recent regulatory change that has really changed the way that we look at these cases, or the way that the Justice Department will look at these cases. And that change is going to be in favor of the farmers that have filed this lawsuit. So keep an eye on this one.
And well, and especially, and you point out in the latest the latest blog article, this also will be interesting because of who and specifically the judge who was assigned the case.
Yeah, Judge Julie Robinson is the judge on this, and I've known Judge Robinson for a long time. She's been on various courts throughout her career, but she is known as a meticulous, by-the-book judge. She's going to approach this very complex litigation, and her track record suggests to me that she's going to be focused on the tension between federal regulation and private antitrust claims. And she's not going to be likely, given her history, to quickly dismiss the case if there is some type of plausible factual bridge that she can find to the harm alleged. And she has a long preference of preferring to let a record develop rather than shutting down litigation early. So I think she's going to be skeptical of Union Pacific's attempt to quickly dismiss the case. And I think this is going to proceed probably on to trial.
All right, Roger, if people want more information, obviously on the two topics of discussion that we had, two very good topics of discussion that we had, these were both blog articles that you posted?
They are. They're on my blog, and I've also shared them with Ag Manager over at K-State, so people can find them on the Ag Manager website.
All right, sounds good. Roger, as always, appreciate it. Thank you very much.
Thank you, Greg.
That is Roger McEowen, Professor of Agricultural Law and Taxation at the Washburn University School of Law, as he joins us this morning on the Ag Issues program here on 580 WIBW.